All right, big tech trying to work a miracle here. Let's bring in our Schwab team as we watch the closing bell. Nate Peterson and Michelle Gibley are with me. Michelle's the Director of International Research, and Nate's the Director of Derivatives Analysis at the Schwab Center for Financial Research. You know, we've been talking about inflation all day, Michelle, but we might have forgotten the Bank of Canada also took a maybe slightly hawkish decision.
Yeah, most developed market central banks are kind of in a wait-and-see mode. We had the Bank of Canada this morning. They said they like what they see, but they need to see it for longer. We also had overnight, we had the Reserve Bank of New Zealand, who said that it was also slightly hawkish, said that rates need to stay high for some time to ensure that inflation is tamed. So, we have this situation. I know you've been talking about the dollar. The dollar's supported because if the Fed is higher for longer while other central banks could cut before them, that keeps support under the dollar. And this does make things a little bit more difficult for central banks overseas. They don't tend to target currency exchange rates, but if they cut before the Fed, it can weaken their currency and reaccelerate inflation and partially nullify the progress that they've made on inflation. But at the same time, if they stay restrictive for too long, when economic growth is slow, that risks a bigger problem. So this could create uncertainty and some market volatility in the coming months.
It's a really interesting point because I was kind of thinking in my mind, all right, we get this powerful data here today, and we recalculate all our Fed odds, and at the same time, the Bank of Canada, which, I mean, there was like a 20% chance they might cut, right? Like it wasn't zero, but it was effectively they probably weren't going to. But the point that you're making is that actually if the Fed is forced to, play a stronger hand, it might actually have some reverberations in the short term as other central banks might have to also try and stick around a little bit longer.
Yeah, and tomorrow we get the ECB. No one's really talking about that yet today either. Markets are not expecting a cut tomorrow, but they are expecting a cut in June. But that probability has come down from, a near, certainty about a week ago to about 80% now. Now, if they think that they could push out from June, and they never promised June, but they've kind of indicated that's when the first cut could happen. And they know that markets are expecting it. If they think they could push out, we could see some hawkish tone from them tomorrow as well.
Okay. That's a fun complication that we're actually going to hear from some important banks, because we're all kind of interpolating the, result for the Fed here based on these numbers, Nate, and that's kind of causing our freak out in bonds. Well, I mean, not a big freak out in stocks, but what do you think in terms of the other central banks, their ability to move the needle this week as well?
Well, obviously it's all kind of correlated together, but
right.
I don't think it's a problem that the inflation is. Look, if we were having soft economic data in conjunction with these 3 monthly prints of hotter than expected inflation, that would be worrisome. But, every time that we come into one of these scenarios here, it just seems to be that inflation is on its disinflationary trends and we're too restrictive, but yet the evidence is just not showing up that we are too restrictive right now. If you look at the 10-year yield, the average, historically speaking, it's around 5.3%. And that's tied to, obviously, the Fed funds rate. But the reason it seems like it's so restrictive is because of the velocity of the move in such a short order, coupled with the fact that we had an economy that's so used to having 0% or free money. And so that's why everybody assumes that it's restrictive. But this data that's been coming out, it seems to be kind of inflecting a little bit higher, looking at leading economic indicators, looking at ISM, manufacturing that moved into expansionary territory, looking at non-farm payrolls. So this data is still strong, and maybe we're too obsessed with rates right now, and it's been that way since '08. And more so, we need to focus just that the economy is strong. And like your previous guest said, this would be good news if the economy could stand on its own 2 feet and we just go back to the mother's milk of the market, which is earnings, and then therefore just put our focus on that.
And we do have that coming up, but it certainly gets complicated in terms of kind of weighing what drives the bus over the next couple of weeks. Did these data push the macro narrative back in front ahead of what had been a very earnings-driven, milky AI trade?
Yeah, and AI is a big pillar. I mean, there's no way that the S&P was going to put up 10% in Q1 if we don't have this AI secular growth story that's going on the back end. So next Wednesday, we get ASML. That's the European NVIDIA, so to speak. And we're going to see what happens with their report. I suspect right now, in these early innings, when in this investment cycle that we're in regards to the infrastructure, that use case is really easy in terms to see how the players are benefiting, how these corporations are making money off of this build out. When we get later down the line, the big story about AI is that it's going to basically buy you time. We saw an announcement out of Google that they're going to be charging for Gemini. Well, you better be able to buy me time if I'm going to subscribe for a search that I already have access to for free that is ad supported. So it's that transition over to the use cases that are actually going to buy time for the corporations and for the consumer. That's still a bit of a question mark, but I think right here, right now in this build out phase, I expect the AI earnings to be strong.
All right. And I think maybe that's why, the AI stuff is higher going into the belly here. Quick last question, Michelle. For some reason today, a bunch of people were tweeting me about Japan. I don't know why, but they were taking today's inflation print and the response, the implication for the Fed, and saying, well, this is going to be the worst for Japan. I don't really get that. I thought that, the Japanese economy was starting to improve a bit, but then the yen got blasted today, so I don't know.
Yeah, I would say most currencies are down relative to the dollar, but the yen is actually holding up a little bit better than the euro and the pound, which is kind of interesting in my opinion. It's not the weakest of the bunch as it usually is. The Bank of Japan's going to move at a very gradual pace. The spread between the treasury yields and the JGBs is wide. That does keep downward pressure on the yen. We had the Prime Minister Kishida in the country yesterday and today, meeting with the Biden administration. That might be part of their focus on Japan. And they're, hoping that companies will continue to invest in their country.
All right. And to your point, yen actually didn't do terrible compared to pretty much everything except the Canadians, where their dollar actually held up a little bit better than the yen. Thanks very much. Appreciate the thoughts here. A couple good subjects outside of what we've discussed already today. Nate Peterson and Michelle Gibley.